Today we're going to be breaking down and ranking the Melbourne hotspots that lots of the buyers agents are pushing at the moment. So we've got Frankston, Sunshine, Broadmeadows, Werribee, Melton, Carrum Downs, Dallas, St Albans, and then I just threw Toorak into the mix for a bit of fun, just to compare what the metrics for Toorak are looking like compared to some of these hotspots. Next up, we've got our tiers. The top tier is the Tim Gurner Property God tier. So to make it into this tier, you've restrained from eating avocado on toast, you've risen above the peasants, and you've ice bathed your way to being a property god. This tier is only reserved for the best of the best. Next up, we've got the Claire O'Neill Sustainable Growth tier. Prices aren't stagnating within this tier, they're growing sustainably.
We want to bring house price growth into something sustainable. So we're not trying to bring down house prices, but we don't want to see some of the growth that we've seen in some parts of the country where you're getting double-digit increases in house prices year on year.
Then we've got the Wagee for Life tier. So you buy in this location, it stagnates in price, you're running a negative cash flow, and you work at McDonald's for the rest of your life. That's the Wagee for Life tier. And then below that tier, we've got the Your Buyer's Agent is Paid by a Developer tier. So this tier is more reserved for the Greenfields housing estates, where your buyer's agent gives you a house and land package that you buy. They charge you 15 grand, and they also make a little bonus from the developer paying them to sell it to you. So we'll see which suburbs make it into this tier. I've got a few in mind. Hey guys, so my webcam literally just died and started making loud noises. So I'm back from JB Hi-Fi with a brand new one. I guess the buyer's agents are after me. So we're going to start by analyzing Frankston. I'm going to put chapters in the video where you can skip through to any of the hotspots that you're interested in, and we're going to fill in the tier list as we go. So hopping into Frankston, you can see that it's quite an established suburb. There's no new land supply coming online. We're located about 50 kilometres from the Melbourne CBD, and the postcode that includes Frankston also includes Frankston South and Coringal. Looking at public housing within the area, there are a few pockets throughout Frankston. Just a pocket in the centre with around 15% public housing, pocket to the south with about 20%, and then a pocket in Frankston South with about 50% public housing. So just watch out for these areas. The owner-occupier percentage really varied throughout the area, so hop on OpenStats and have a look for yourself. Could be as low as 30% in some areas, could be as high as 70% in some areas. From a town planning risk perspective, you can see there's some bushfire management overlays where the dense vegetation lies, and we've got a special building overlay in the dark blue. So special building overlays are generally just areas that are more inclined for a bit of inundation, but they're not necessarily flood areas. But I personally would probably try to avoid purchasing in the special building overlay areas. You can see to the north there's a land subject to inundation overlay near Cannonook Creek. And this town planning data comes from landchecker.com. Really good free town planning resource. Check it out. Median asking price for a 3-bedroom house is currently sitting at just over $800,000. And this market has moved over the last few months. I remember looking at it a few months ago and it was around $750,000. Now it's, starting to break out over that $800,000 price point. I know tons of buyers agents are trying to get clients properties within Frankston at the moment. Looking at the vacancy rates within Frankston, they're sitting around 1%. So that's relatively tight for suburban Melbourne, and they have been relatively tight since about 2017 within Frankston. You can see that rents within Frankston were really sort of starting to run up since about 2020, and that's probably a function of this tight vacancy rate mixed with just the interest rate hiking cycle. Investors' mortgage payments have jumped up, and if the market allows them to, they're going to raise rents to try to pass on that cost to tenants. Just the way the market works. Looking at the stock on market, it's been relatively consistent since about 2017, and the current days on market for the suburb of Frankston sitting at 23 days, so that's becoming quite a hot market. The gross yield within Frankston, last time I checked it, I think it was around 4%. It's now dropped to 3.6%. And that's really just a function of rents sort of staying relatively flat over the last few months, but prices increasing quite dramatically. So if you're purchasing that median 3-bedroom house at $820,000, getting that gross yield of 3.6%, you're running a negative cash flow of $19,000 per annum pre-negative gearing. So that's quite painful from an investment perspective. You need to ensure that you're getting really good capital growth if you're running this negative cash flow. Additionally, just looking at the median house price to median income ratio, it's sitting at 9.2, which is relatively high at the moment. You look in regional Victoria, some of the areas that I'm looking at, they have ratios of, 5 and 6, but I guess that's just suburban Melbourne. It's going to have a higher ratio generally. So looking at Frankston, I think I'm going to put it in the sustainable growth tier. The vacancy rates are decent. We're quite far from the Melbourne CBD. The affordability ratio is sort of getting up there. The days on market has dropped a lot and it's looking to be quite a hot market at the moment. And from what I've heard, there's quite a lot of demand from both first home buyers and investors. The yields are relatively low now at 3.6%, so you're running quite a painful negative cash flow at around $19,000 per annum. So up next, we're looking at Sunshine, situated in the beautiful west of Melbourne. We're about 14 kilometres from the CBD. So Sunshine's very much an established suburb with no new land supply coming online. From a public housing perspective, there wasn't much public housing. There was a pocket of around 30% in Sunshine West, and then a pocket within that Sunshine Albion area of around 10% housing tenure. As always, the owner-occupier percentage sort of varied, some areas as low as 30%, some areas as high as 80%, so check it out for yourself. Looking at the town planning risks, there were some special building overlays in the dark blue across some of the areas, and there was some land subject to inundation overlays, but they generally followed these creeks and drainage channels through the suburb. So relatively good from a town planning risk perspective. Looking at the asking price for a 3-bedroom house, it's currently sitting around $700,000. It's been pretty stagnant since about 2018, I'd say. So that's quite good. We've had a solid 7 years of the market not doing much. Looking at the vacancy rate of Sunshine, it's sitting just over 1% at the moment. We can see that it ticked up quite a lot during that COVID period when Melbourne was really heavily locked down. And we can see since about 2022, rents have been inclining upwards. Looking at the stock on market of houses, it's a bit all over the place. It tightened up around that COVID era and has sort of come off. The days on market's currently sitting at 46 days for the suburb of Sunshine West. So a bit of a moderate market at the moment. Yields within Sunshine are a bit more attractive than Frankston at 4%. So if you're purchasing that median 3-bedroom house for $700,000, running a 4% gross yield, you're running a negative cash flow of around about $14,000 per annum before negative gearing. The affordability ratio is also decent at 7.6. That's better than Frankston. So I'm going to place Sunshine in the property god tier. I like it a lot. I like that we're very close to the Melbourne CBD. We're about 15 k's west of the CBD. The median 3-bedroom house price is around $700,000, which is very affordable for, the eastern seaboard at the moment. You'd be struggling to pick up a house for $700,000 in Brisbane and Sydney. The yields are okay at 4%. I mean, it's Melbourne. We have ridiculously tight yields. The vacancy rates are relatively tight at 1%, and the days on market are warm at around 40 days. So I think it would be easier to pick up an investment property in Sunshine than Frankston at the moment, just due to that days on market. I think the confidence in the Melbourne market has really just been restored since that first interest rate cut. Okay, so looking at Broadmeadows and Dallas now, all the data comes on a postcode level. So you can see this postcode has Dallas, Broadmeadows, and Jacana. I mean, Broadmeadows and Dallas are pretty similar suburbs. They're only a few k's away from each other. So this area is also 14 k's from the Melbourne CBD, and it's an established suburb. There's no new land coming online. All of this land over here is parkland and protected. So looking at the public housing within the area, you can see over to the west of the train line, we have this massive pocket, which is basically 90% public housing, and that's right next to the Kangan Institute. We can also see that we have this pocket of around 25% public housing to the south. And again, the owner-occupier percentage varied throughout the area. So hop on OpenStats and have a look for yourself. There were a few special building overlays throughout the area, so just watch out for those. And we have a land subject to inundation overlay down where the river/creek is in that protected area. So relatively safe from a town planning risk perspective. The asking price for a 3-bedroom house in this postcode was sitting at around $550,000. You can see we've also been quite stagnant in the area since about 2018. The vacancy rate is currently sitting at around 1.5%. It's a bit worrying that we've kind of ticked up since 2024 till now, and obviously a massive spike upwards during that COVID era. We can see that rents were also quite stagnant but have been rising since about 2022. Stock on market of houses has been relatively consistent, and we can see that the days on market for Broadmeadows is currently sitting at 43 days and 35 days for Dallas. So these are relatively mild markets, not as hot as Frankston at the moment. Looking at gross yields within the area, they're sitting at 4.4%. So that's about as attractive as you're going to get for Melbourne. So if you're purchasing that median 3-bedroom house for $540,000, getting that gross yield of 4.4%, you're running a negative annual cash flow of $9,000 pre-negative gearing. And you can see the affordability ratio sits at 8, which is moderate. So I think I like both Broadmeadows and Dallas. I'm going to put them both in the property god tier. I'm just going to squish them up because my face is in the way. I think I might actually move Sunshine down to the sustainable growth tier and keep Broadmeadows and Dallas in the property god tier. So my reasoning for putting Broadmeadows and Dallas in the property god tier is I like the proximity to the Melbourne CBD. We're 15 k's north. It was interesting that the vacancy rates have sort of ticked up in the last 6 months within both of these suburbs, but it's nothing really to worry about, just given the amount of population growth that's projected in Victoria into the future. Also, the property development market is challenging in the short to mid-term, so developers can't produce enough stock to keep up with the incoming demand. I think the yields of these two suburbs are about as good as you're going to get it in suburban Melbourne, and just the price point being at that mid-500s level, it's just that bit more affordable than Sunshine at around $700,000, which is why I'm just moving Sunshine down. I think these two suburbs are probably better value. Although in saying that, I think I can see Sunshine sort of gentrifying before Dallas and Broadmeadows, given that it's a big activity centre within Melbourne, got a big hospital, huge train station, and I think the government has just pledged $2 billion. So I think Sunshine is going to get a brand new train station. So next up, we're looking at Werribee. So Werribee's about 33 kilometres west of the Melbourne CBD. And although Werribee's somewhat established around the train station and the CBD of Werribee, there's quite a lot of new land supply coming online in the areas around Werribee. So we've got huge housing estates in Point Cook, we've got Wyndham Vale with huge amounts of land coming online, and we've got housing estates to the southwest as well along that rail corridor. So this is just a photo from realestate.com, and you can see all of these housing estates with lots of stock online around the Werribee area. Obviously, if you were to purchase in Werribee, I would be sticking to this established area and trying to get a big block of land. But I just really don't like the fact that we have so much supply coming online and we're quite far from the Melbourne CBD as well. Like, developers are just pumping out brand new houses in these estates around the $700,000 level, and that's a brand new 4-bed, 2-bath, 2-car. So if you think about this logically, even if you buy in that established area of Werribee, you're just going to have that extra pressure of lots of new houses coming online around that $700,000 level, and I think it's going to suppress your capital growth, at least in the midterm. Looking at the public housing within Werribee, there were a few pockets, just a pocket of 30% and 20%, and the owner-occupier percentage generally sat around 65%. What I would note is that there's generally better owner-occupier levels in the new housing estates, but I would steer clear of them just because of that supply coming online. From a town planning perspective, we were relatively clear, no risks that were standing out. Looking at the asking price of a 3-bedroom house, we're currently sitting at around $600,000 within Werribee, and the vacancy rate within Werribee was relatively loose at around 2%. We can see that rents started to run up around 2022, and it looks like they're sort of coming off, and the stock on market has stayed relatively consistent but slightly tightened up over the last 5 years. Days on market for the suburb of Werribee is currently sitting at 34 days, which is relatively moderate. So I think I'm going to place Werribee between the wagee for life and your buyer's agent is paid by a developer tiers. I think if you're going to purchase within Werribee, stick to the established areas. But if you're going through a buyer's agent and they're feeding you properties in those developing housing estates, they're most likely being paid by a developer. I just really don't like the fact that we just have so much land supply coming online. I would much rather just stick to the established, more infill suburbs within Melbourne. And the thing is, if you get some good price growth within Werribee, it's going to mean that the developers are going to be more profitable and they're going to up the amount of stock that they produce. And more stock online basically helps to keep prices repressed. So on to Melton now. I'm not going to beat around the bush. I don't like Melton either for similar reasons to Werribee. So we're 45 kilometres northwest from the Melbourne CBD. And again, although Melton is established, we have huge amounts of land supply coming online. I probably like Melton less than Werribee, to be honest. And part of that is this western corridor from Ravenhall to Melton. Huge amounts of land supply coming online within these estates in Thornhill Park, Rockbank, Aintree, Deanside. And all of the biggest developers in town have numerous estates within this precinct. We've got the Woodley estate, which is a joint venture with Mirvac. We've got numerous Stockland estates throughout that corridor. You can just see all of these estates developing with all the stock online within them. And looking at some of the stock that you can get, you know, a 4x2 for $550 to $580. Developers are just going to pump these out as soon as there's any meaningful price growth within that Melton corridor, and that's going to keep prices repressed in the midterm. Again, if you're going to purchase within Melton, stick to the established areas. Try to purchase something on a big piece of land with lots of amenity around it, and steer clear of any of these housing estates. From a public housing perspective, there were just two main pockets that didn't even have that much public housing, 15% and 20%. Owner-occupier percentage was generally around 65% for the area. No town planning risks. Median asking price for a 3-bedroom house is sitting just over 500 grand. Vacancy rates are above 2%, so that is not particularly tight, and that's probably a function of just the incredible amount of land supply within the area. Rents, again, have really run up since about 2022, and gross yields within Melton are sitting around 4.2%. So if you're purchasing a 3-bedroom house for 520 grand, running that 4.2% yield, you're running a cash flow of negative $9,600 per annum, thereabouts, before negative gearing. So for exactly the same reasons, I'm going to put Melton between the wagee for life and your buyer's agent is paid by a developer tier. So again, if you are going to purchase within Melton, stick to the established areas, but I just don't like it given how much land supply there is within that western corridor. Vacancy rates aren't great at around 2.5%. We're located very far from the Melbourne CBD. Houses are still relatively affordable, around $520,000, but for slightly more you could purchase 15Ks from the Melbourne CBD in an established area like Broadmeadows or Dallas. Next up, we're looking at Carrum Downs, about 50Ks from the Melbourne CBD. It's an established suburb with no new land supply coming online. It may look like there's new land supply coming online within this image, but I pulled up the zoning and you can see that that land is all zoned green wedge zone. and that's not a developable zone. You can also see that that pocket to the north of Carrum Downs is basically a floodplain as well, so town planning isn't going to allow you to build on that area. There were only 2 pockets of public housing with pretty low percentages, 15% and 10% within the suburb, and the owner-occupier percentage was really good, generally around 80%. Looking at the asking price for a 3-bedroom house, just sitting sub $700,000. It looks to have run up from about 650 grand till now. Vacancy rates are pretty tight at around 1% and have been relatively tight since about 2015 within the area. And that's probably just a function of the fact that there's such a high owner-occupier percentage. There's probably not that many investors renting out their homes within the area. So it's probably pretty hard to get a rental. Rents have been running up within the area since about 2020. And stock on market has been very, very low since about 2016. Days on market for the area is very hot at 14 days for Carrum Downs. And the gross yield within Carrum Downs sits at 4.3%, which is pretty attractive for Melbourne standards. If you're purchasing that 3-bedroom house for $685,000, running that 4.3% gross yield, you're running a negative cash flow of $12,000 per annum. The affordability ratio sits at 7, which is pretty good for Melbourne. We are going to put Carrum Downs between the sustainable growth and the property god tier, I reckon. Basically, good owner-occupier percentages, really tight vacancy rates, relatively attractive yields. House prices are under $700,000, but we're still relatively far from the Melbourne CBD. I think Carrum Downs is really attractive. So we're looking at St Albans now, and the postcode also includes King Park and Albanvale. It's about 20 k's northwest of the Melbourne CBD. It's an established suburb with no new land supply, train line running through the middle, sitting just north of that Sunshine precinct. From a public housing perspective, we had one pocket near Jennifer Station at around 40%, and then we had a pocket with around 20% over to the east. There are a few special building overlays within the area and a few areas of land subject to inundation. Median asking price for a 3-bedroom house is sitting around $650. Vacancy rate is around 0.6%, very, very tight. Looks to have just tightened up a lot since that COVID era. Rents have been running up since about 2022. Stock on market looks pretty consistent, and the days on market for the suburb of St Albans is currently sitting at 51 days, so bit of a cool market within St Albans. Yields within St Albans are sitting at 3.9%. So if you're purchasing that median 3-bedroom house for 655 grand, running that 3.9% gross yield, you're getting a negative cash flow of $13,600 per annum pre-negative gearing. So it's moderate. It's not the greatest. The affordability ratio sits at 9. I think I'm going to place St Albans in the sustainable growth tier, but towards the bottom. I think I like Sunshine a bit more. We just have a bit more amenity in Sunshine. We're only a bit more expensive, and we're 5k's closer to the Melbourne CBD. I do really like St Albans though. We're a very established suburb. We've got a tight vacancy rate. Yields are okay. Bit tight. The price point of $650 is still very affordable, and I think the days on market is relatively cool at the moment. You could be able to get some good deals within the area. I would just say that days on market is a bit of a lagging indicator. You could hop in the market right now and it may be very tight. I don't know the St Albans market that well. Okay, and now onto the fun suburb of Toorak. We're situated 8k's from the Melbourne CBD. Very established suburb, no new land supply coming online. If you think there's spare land over here, it's not. It's the prestigious Kooyong Tennis Club, and I'm fairly certain Toorak is the most expensive suburb in Melbourne. I did not look that up. From a public housing perspective, there's basically none. There's like a small pocket to the south of where the postcode actually cuts off. The owner-occupier percentage was generally very high at around 80%. There were pockets with 50% private rentals within some of the areas. And I think part of that is there's a fair amount of older 70s style apartment blocks, and I think lots of people own them as investment properties. There's a few special building overlays around the area, and there's also a land subject to inundation overlay along the Yarra River. So for Toorak, I'm just filtering on all houses, and the median price of a house is sitting just above $3 million. Vacancy rate is quite loose at around 2%, and you can see it almost reached 10% during that COVID peak. And I think part of the reason for this is, we're in inner city Melbourne. There's quite a lot of apartment stock online. You can see that weekly rents for houses have also run up since about 2022. And you can see for a house, you're probably paying anywhere between $1,500 and $2,000 a week in rent. And you can see the stock online. It's mostly units, and there's a smaller stock of housing. Median days on market for the suburb of Toorak sits at 50 days, so not a very hot market. Could potentially get a ripper deal, take $1 million off that asking price. Gross yields for houses within Toorak are quite sharp at 2.6%. So if you're purchasing an investment property there, buying a house for $3.2 million, which is the median house price, running that 2.6% gross yield, you've got a negative cash flow of around about $100,000 per annum. And the affordability ratio is quite high at 21.6. So you can see the median income within Toorak is around $150,000, and the median house price is 3.2 mil. So Toorak, I'm going to put in the property god tier, because if you can afford to purchase within Toorak, you're probably a property god. So that's the end of the Melbourne Hotspots tier list video. If you don't like my thoughts on Werribee and Melton, abuse me in the comments section down below. And if you enjoy my content, check out my channel. I've got heaps of other investment property content, free models and spreadsheets. And I've also got a free Discord community where I'm often in there ranting and raving about property. I've found Discord communities to be really helpful. You can share tips and what you're seeing in different markets with the community. And we were just trying to do something different and a bit fun with this video.